that Guyana is at a crossroads at this point. This is probably one of the most important of the events that we will do. This is really the crux of how Guyana goes ahead. As you know, accelerated fiscal expenditure will increase domestic inflationary practices, potentially, as it were, creating a great deal of stress within the Guyanese environment and certainly internationally. So I look forward to very active discussion and thank you all for participating.
Thank you, Professor Brian. So today we are very fortunate to lead this off. When I envisaged how we might structure this program, I thought what we needed was someone to give us a broad technical sense of some of the challenges that go to the broad issue of fiscal policy, and then to touch on the implications for those policies in Guyana. And that would be followed by someone from the economic perspective who was locally attuned to Guyana, who sort of lived in Guyana, and then sort of to widen out the lens and to think about it within the context of the region, and then more broadly to widen out the lens and to think about it within the context of the world. And today we're very fortunate to be joined by Professor Colin Constantine, who, given my reading, is one of the foremost sort of Guyanese economic thinkers on these matters. He brings to us a wealth of understanding, and I don't want to take up much of the time. Colin, welcome, and you can go ahead and share your slides and help us to better understand these ideas of fiscal policy.
All right, thank you, Terence. Just give me a moment. Great. Could you confirm that you can see my screen?
Yeah, it's there. Yeah.
Brilliant. All right. Terence, thank you very much for the kind invitation. Indeed, you did ask for some clarity on fiscal policy in Guyana's new economic circumstance, and I hope to make a small contribution in trying to present a better understanding of some of these issues. All right. So I think I have 50 minutes thereabouts. So I just have 14 slides, but there is a detailed appendix to pick up the more details of some of the things I say here. All right, what I mean by old wine with this slide is that, look, monetization of fiscal deficits is a classic problem for economies across the world, particularly developing economies. We monetize because, well, we lack fiscal institutions in terms of tax collection, or we lack earning potential in terms of earning foreign exchange. The new bottle here, well, the latest case that is prominent, of course, is Ghana. And I just want to briefly read some of the headlines from the World Economic Forum in 2019.
Can you move the slide to your second? Can you go to your second slide? We're just seeing
What are you saying? Sorry?
We're just seeing the fiscal policy in Guyana's economic landscape.
I have moved it, you know. Should I stop sharing and try again, Terence?
Yes.
All right.
Maybe if you want to upload the slides themselves.
You mean to the chat?
Yes. Just try to do it once more, because we only saw the.
I'll share my entire screen. That's fine. Could you see this now?
Yes, this is better.
Old wine, new bottle?
Yes, we see old wine, new bottle, yes.
Brilliant. As I said moments ago, the old wine is the classic problem of monetized deficits. I'll explain what that means in a few minutes. And the new bottle is just the latest case, that is Ghana. Of course, Ghana was touted as the fastest growing economy in 2019. If you fast forward a few short years, it promised, the central bank in Ghana promised to start monetizing the deficits. That was an agreement it reached with the IMF in exchange for $3 billion bailout. And, when we teach economics in terms of debt crises, we don't teach our students that governments default on domestic debt because government can always find local currency to pay. But Ghana presents an interesting case of domestic debt default, as highlighted here in the FT. So I'm going to connect this, of course, with the Guyana problematic of fiscal policy in the case of oil discovery. All right. So the big question, I think, on everyone's mind is, one, are the deficits too big, right? And how do we position that question in the context of absorption constraints? That's a term that's been used a lot. All right, so I hope to add some clarity to that. What we see here from 2009 to 2023 is the non-oil primary balance as a share of non-oil GDP. So primary balance means we're omitting or not including net interest payments. Yeah, and it's non-oil because it's just government expenditures minus tax revenue. Now, this is the best indicator of fiscal stance, right? The proof is in the pudding. After 2019, we can see a significant growth in fiscal deficits as a share of GDP, the non-oil primary fiscal deficit. This is the best indicator because if we were to use, for example, the overall primary balance or the overall balance, these things will change with oil revenue, right? So we don't know if they're moving because of a change in fiscal stance or just because of the oil market. The same is true if we use a non-oil fiscal balance to share GDP. GDP certainly will change with oil market conditions. So the big goal with this particular slide is to say, if we want to understand the fiscal position of any government with oil discovery, we need to look at the non-oil primary balance as a share of non-oil GDP. All right, indeed, before 2020, about 5% of GDP on average, was the size of the primary balance as a share of GDP. Now we know that it's approximating 30% in 2023. Significant jump from the norm of 5% on average thereabout. Significant jump. All right, so how is this deficit financed? Well, if you read the press, if you read the budget reports, it's financed by external debt, it's financed by domestic borrowing, and it's financed by withdrawals from the Natural Resource Fund. Is that so? All right, what we have here is data from 2009 to 2023. The first thing I want to draw your attention to is this dotted line. This dotted line is the size of total government expenditure, central government expenditure. The line below with the X is the Bank of Guyana financing of central government. If we were to divide Bank of Guyana financing of central government by total government expenditure, then we get the Bank of Guyana's share of deficit financing. All right, so for example, in 2014, total about 20% of government spending was financed by the Bank of Guyana. If you fast forward to about 2021, it's approximately 60%. Today, 2023, it's a little over 20%. The point I want to emphasize with this slide is that since 2014, based on IMF data, since 2014, an increasing share of total government spending is financed by the Bank of Guyana. That means it's not financed by domestic debt, it's not financed by external debt, it's not financed by withdrawals from the Natural Resource Fund. This is what we mean by monetization or money creation of the fiscal deficit. All right, some additional evidence of money-financed fiscal deficits. So we have this thing here called base money, and this is growth rate of base money. Now, base money comes from the central bank, all right? And there are two sources of base money. Whenever the central bank funds government spending, it increases reserves in the banking system. Or if the central bank buys foreign exchange from, say, GBTI or Republic Bank, it increases base money in the banking system. All right. So what I want to do here is to identify the source of the significant increase in base money. So in 2010, for example, the growth rate might have been about 5%. Today, it's about 60%. The growth in base money, which comes from the Bank of Guyana. Now, you can see with this dotted line here, this is the growth rate of net foreign assets in the Bank of Guyana. It's oscillating around zero. The key point is that the big growth in base money is not about accumulating foreign assets from the banking system. The solid line is other, according to the IMF, including Bank of Guyana net credit to the public sector. And you can see there's a tight relationship between the growth rate in central bank financing of the deficit and the growth rate in the base money. All right, so if base money is growing and it's growing because of monetization, then we can conclude with this slide and the previous slide that indeed fiscal deficits are money financed. All right, so there are two ways a central bank can finance the fiscal deficit. One, the central bank can buy bonds issued by the Treasury, credit the deposit account, and the government can spend from that deposit account. And that is indeed happening in the Guyana case. It's just not where the big action is. It's not where the big story is. The second source of money creation would be government simply writing checks and withdrawing reserves from the government deposit account at the central bank. So what I have here is the change in government deposit balance at the Bank of Guyana. A change means if it's falling, that is proof or evidence of monetization. We can see from 2010 to 2020, significant contraction in the change in government deposit balance at the Bank of Guyana, and the same is true in 2021. If there was no money financing, all right, then the change in government deposit balance would be zero, or it would be stationary along zero. Now, whenever there is a reduction in the government deposit balance at the Bank of Guyana, which is monetization, the central bank increases reserves in the banking system. When government writes a check, deposit increases in the banking system by that value, and reserves must rise. That increase in reserves is exactly what the commercial banks now use to buy T-bills, and we call that domestic debt. So the key question with this point is, do local banks in Guyana finance the fiscal deficit? If I give you $5 to buy shares in my company, have I borrowed $5 from you? All right. We can see here that this is external debt as a share of non-oil GDP. It's falling consistently. We can see from 2014, domestic debt share of non-oil GDP has risen tremendously. For example, in 2023, it's about 45% of non-oil GDP. In 2024, it's less than 15%. Now, as I mentioned earlier, when there's a reduction in government deposit balance at the Bank of Guyana, the banking system is flushed with reserves. It is these reserves that they use to buy treasury bills, and we call them debt. But this is not domestic debt in the conventional sense. Certainly not domestic debt when the US Treasury issues bonds, or the UK Chancellor of the Exchequer issues bonds. We call that domestic debt because it's being sold to households and firms. And the idea is we want to replace households and firms' demand with public demand. That is not what is happening with this increase in domestic debt. All right. Do remember that reserves that are used to purchase T-bills comes from the government. All right. So we've established that there is monetization of the fiscal deficits. The key question is, what are the effects? All right. The textbook thing is that monetized deficits, or indeed excessive deficits, should be inflationary, but that's only if the change in non-oil current account is equal to zero. In other words, if the government spends lots of money, we could sidestep the inflation problem by simply importing cheaper goods. Yeah. Now, of course, not everything we can import. So non-tradable inflation could increase. So we need to disaggregate the CPI inflation rate between tradable and non-tradable inflation. I don't have that data to present here, unfortunately. But as we can see, the GDP deflator, which would account moving beyond the consumer basket, meaning the rate of change of goods produced within the economy, goods and services, is a tight relationship between that and the consumer basket. The consumer basket is a fixed basket of things we tend to buy each month. Very different from including the cost of investment goods, for example. All right, indeed, after 2020, we see a big surge or relative surge in inflation, but GDP skyrocketed. Sorry, GDP deflator skyrocketed relative to the CPI. Much of this, though, indeed is accounted for with improvement in terms of trade, meaning oil price increase. Yeah, so this is not necessarily a consequence of monetized deficits. What is interesting is comparing Guyana's inflation rate to its major trading partners. That would be Trinidad and Tobago, Japan, the United States, and China. In 2015, thereabout, it had the lowest inflation rate. That's obvious. But if you look beyond 2015, 16, 17, 18, 2021, etc., it's much higher than most of its trading partners. This is important because this affects the real effective exchange rate. All right? All right, so again, 2009, 2023, first thing, we observe a depreciation of the bilateral rate between Guyana and the US dollar. Right? Textbook thing, we do expect that from monetized deficits, right? Tend to depreciate the bilateral rate. There's an excess demand for foreign exchange, and that rate falls. All right? But it could also increase non-tradable inflation. And if that increase in inflation outstrips its competitors, then we could observe a real effective exchange rate appreciation. And that's what we see in the solid line since 2014. If you recall the previous slides, the IMF dates monetization in Guyana from 2014. So indeed, there is significant appreciation of the real effective exchange rate. One final point here is that as it relates to Dutch disease, lots have been said about Dutch disease in oil economies. The exchange rate that is relevant in this case is not the bilateral rate between Guyana and the US dollar. It is the real effective exchange rate, which is a weighted average exchange rate. So it accounts for changes in Guyana's nominal rate with its major trading partners, but also its inflation relative to its major trading partners. All right. So an appreciation of the real effective exchange rate, in theory, means its exports are becoming less competitive. All right. Now, from 2009 to 2023, we can see a significant growth in net domestic assets in the banking system, and that's what this dotted line is showing us. All right. This line with the circle is showing relative growth, indeed, of net foreign assets in the banking system. And if we were to divide the net domestic assets by the net foreign assets, we get what I call a bank diversification ratio or a bank diversification constraint. And that's this solid line. We can see after 2014, after the period of monetization, according to the IMF data, significant growth, right, in net domestic assets relative to net foreign assets in the banking system. Several points are important to raise here. First, this diversification ratio cannot rise without limit. Second, of course, banks are now more exposed to local assets relative to foreign assets. This third point is, if banks are accumulating net domestic assets at a much faster rate than net foreign assets, then we cannot conclude that banks are hoarding foreign exchange. If there's a foreign exchange issue, certainly it's not because of bad behavior per se by the bank. We're just not seeing this in the data. Mm-hmm. All right, time period is the same, 2009 to 2023. The dashed line is capturing the Bank of Guyana's net purchase or sale of foreign exchange to the local banking system. So, for example, from 2009 to say 2013, the Bank of Guyana is selling foreign exchange to GBTI, Republic Bank, whatever. They're selling foreign exchange to the local market. Note carefully that this solid line is now capturing the volume of interbank foreign exchange trade in Guyana. So when the Bank of Guyana is selling foreign exchange to the banking system, interbank trade is also increasing. After 2017, the Bank of Guyana is net buying foreign exchange from the local market, meaning after 2017, in this period here, they're buying more than they're selling from GBTI, Republic Bank, what have you. When they do that, interbank volume of foreign exchange trade in the banking system is falling. So there seems to be an inverse relationship between net purchase and sale at the level of Bank of Guyana and interbank volume trade. And that's what we should expect, by the way. Yeah. Mm-hmm. All right. So what this little chart captures is, what are the banks doing when there is a net increase in aggregate demand coming from an increase in the fiscal deficit? So, for example, on this axis here, we can see in this region and this region, there's a positive change in the non-oil primary bonds. Government is spending a lot more. If you recall the very first slide, I think it was, we moved from 5% of non-oil GDP to about 30% in 2023. All right, so that's what's being captured in this region. Now, what's being captured in this axis is the amount of foreign exchange banks would bring back from the United States or from Europe. All right, so whenever there's a net increase in the fiscal deficit, we can see in the following years, 2019, 2020, 2023, 2014, 2011, 2012, in these particular years with bigger deficits, banks are actually bringing foreign exchange back to meet rising demand. Of course, if the fiscal deficit is going to increase, we're going to demand more locally produced goods and services, of course, more imports as well. So there's a net increase in aggregate demand for foreign exchange. And banks, I think, are doing what we expect banks to do, right? That is to bring foreign exchange to meet the demand. This graph is also capturing, well, what does the Bank of Guyana do when there's a net increase in the fiscal deficit? So in 2019, 2020, 2022, 2023, 2021, significant increases in the fiscal deficit share of nominal GDP. The Bank of Guyana is buying more foreign exchange than they're selling to the banking system. All right. So there are two things happening here. There's an increase in aggregate demand for foreign exchange because the fiscal deficit is much bigger. The Bank of Guyana is also buying more foreign exchange than they sell to the local banking system. And the net effect in these particular years would be an excess demand for foreign exchange. All right, this is my penultimate slide. This graph here is capturing foreign exchange intermediation by the banking system. So I divide the volume of foreign exchange sold by banks by the volume of foreign exchange purchased by banks in the local market. So A value of 1 would mean perfect foreign exchange intermediation. The quantity purchased is equal to the quantity sold, and that's what we want. That's certainly what we want in some dynamic sense. If it's above 1, it means banks are selling more than they're buying from the local market. So they're over-intermediating, if you will. If it's less than 1, banks are buying more than they sell from the local market. So they're under-intermediating, or there's disintermediation of foreign exchange. All right. Please note that in this data, from 2009 to 2023, the average value is 1. So over this time horizon, there is perfect intermediation of foreign exchange market. I have data for much longer series from 1990s to present, and it's the same value. So on average, banks are intermediating foreign exchange. Now we do observe 2 anomalies. 2014 and 2015, they net sell. They sell more than they buy in those 2 particular years. Barring those outliers, they tend to oversell and undersell, and in a dynamic sense, to ensure that they perfectly intermediate foreign exchange. So based on 2020, 2021, 2022, 2023, there is normal bank behavior as it relates to foreign exchange intermediation. What we compare here, again, is the net increase in aggregate demand because of a significant increase in the fiscal deficit share of non-oil GDP. That's these 2 regions here. And we're capturing here the change in foreign exchange intermediation. So for example, if it's positive, banks are net selling to the market. If it's negative, they're net buying, or they're disintermediating or under-intermediating foreign exchange. All right, 2 or 3 points I want to emphasize. First, we can see that when there's a net increase or a fiscal stimulus, banks tend to net buy foreign exchange in the local market in the following years, 2019, 2011, 2023. So indeed, banks are buying more than they're selling into the private sector whenever there's a net increase in aggregate demand because of a bigger fiscal deficit. What I want to emphasize, however, is that this disintermediation here is more or less consistent with normal bank behavior. So 2023 and 2017 rather, not very different, all right? And that's exactly what we see with this graph, all right? They're above and below 1. I'm trying to average it out with a mean value of 1 over time. What is different, obviously, is the change in the fiscal balance. Look at 2020, look at 2022, look at 2023. Of course, that has to do with a significant increase in the size of the fiscal deficit. So 2 things will produce an excess demand for foreign exchange here: significant growth in the size of the fiscal deficit and foreign exchange disintermediation. Except foreign exchange disintermediation is consistent with historical trend. So I'm going to conclude here, and I'm going to say that if we have excessive fiscal deficits, they tend to lead to all kinds of curses. I mean, I'm sure Guyanese are inundated with all manner of curses. Well, there could be a finance resource curse where there's a paradox of plenty, meaning, well, we're supposed to be rich with foreign exchange, but then we have a problem with access to foreign exchange. Or there could be a paradox of banking, the interest rates could rise and we expect banks to be flush with liquidity and interest rates should fall, right? These things tend to produce property booms and busts like we observe in Trinidad and many, many other countries. There are well-known real economy constraints that excessive deficits could violate and lead to accelerating inflation. It could lead to labor shortages, reallocation away from sectors that are not related to oil, from sectors that earn foreign exchange, right? Labor could move to high-wage sectors. Think of retail, think of construction. These things can lead to an appreciation of the real effective exchange rate and produce an excess demand for foreign exchange. But there are well-known institutional constraints in countries like Guyana: planning, execution. Ultimately, and this is whether we have oil wealth or not, fiscal policy should aim for neutrality on banks' diversification ratio, change the government deposit balance to the monetary base, of course, the foreign exchange market, that's our life and blood in our type of economies, and ultimately, central bank independence. We should end Bank of Guyana financing of the deficit. If we violate these neutrality rules and these other constraints, we can conclude safely that we have excessive fiscal deficits. Terence, thanks.
Well, you've given some real good food